it's my great pleasure to introduce the last session of today, the Wallenberg Lecture. We started this some years ago, the annual lecture, but we renamed this the Wallenberg Lecture as a signal, as a gesture of gratitude also for the support that we received from the Wallenberg Foundation over the years. And I will now hand it over to Rajna Gibson, who is going to moderate the Wallenberg Lecture, and she will take it from here. Thank you.
So good morning, good afternoon, everybody. I went to visit the swimming pool, the Olympic swimming pool, and I must say it's nice to see that there's still some people in the room. It's absolutely fantastic, this new campus. All the University of Geneva students would be jealous anyhow. So it's a great pleasure to moderate this panel, and of course the culminating point of today is going to be Professor Laura Stark's lecture, the Wallenberg Lecture. Before giving her the floor, I would like to pass the word first of all to Ms. Petra Hedengran, who is the General Counsel and Head of Corporate Governance at Investor AB, and I think you will say a few words on behalf of the Wallenberg Foundations. Yes? Right. So maybe Guido, yeah. Do you want to stand up? Sure. There's a microphone.
It's on. Okay, thank you. So let me just start by saying that I am delighted to be here amongst a group of people with deep knowledge and expertise in one of my absolute favorite areas, corporate governance. And I'm proud to represent Investor AB, which is one of the patrons to ECGI and which was there from start when the foundation was established. But today I also represent the Wallenberg Foundation, which have given name to the Wallenberg Lecture. So I would like to say a few words about the Wallenberg Foundations. The Wallenberg Foundations is the collective name for 16 non-profit public and private foundations which are established by individual members of the Wallenberg family. The endowment of these foundations have either been donated by Wallenberg family members or raised through collections to honor family members. Together, the foundations fund researchers and research projects beneficial to Sweden within areas like natural sciences, technology, and medicine. Since 1917, when the largest foundation was established, the foundations have granted around 4 billion euro to research. At each point in time, the foundation supports about 1,000 researchers and have launched several strategic research programs in basic research with the main goal to establish long-term competence in key strategic areas in academia, industry, and society. The wealth of the foundations is invested in a number of international companies, of which Investor, that I represent, is one. And of course, Investor in its turn is a long-term owner of global companies. And it's the capital distribution from these companies which allow the foundation to support research. And in this way, the Wallenberg Foundations create an ecosystem where about 80% of the capital distributions from the companies is granted to research, while 20% is reinvested in existing or new companies to generate additional operating income over time. So consequently, it is the success of the companies that makes it possible to support research projects. Therefore, it's not an exaggeration to say that corporate governance is of high importance to the Wallenberg Foundations. And for Investor, I would say it's one of the cornerstones of our business. So it gives me a great pleasure to introduce and leave the floor to the 2022 Wallenberg Lecture. Thank you.
great pleasure. Thank you for your words to now introduce Professor Laura Starks. So she holds the George Kosmetsky Distinguished University Chair at Macomb's Business School at the University of Texas at Austin. We talked a lot about corporate governance. I think she contributed in this field about the role of institutional investors in corporate governance. And now I think she's going to talk about blending corporate governance, responsible investing, and climate risk. So we are very excited and delighted to have you talk today about corporate governance, institutional investors, and climate risk.
So thank you very much. I want to thank the Wallenberg Foundation and Marco and the ECGI. It's my great pleasure to be here today to talk about this. And it's interesting that this is coming right after Elizabeth's great paper presentation. So I wanted to talk about corporate governance, institutional investors, and then look at climate risk in particular as an example. Oh, did start working. Okay, so as ECGI has long recognized, good corporate governance is central to a successful firm. In fact, corporate governance is the primary element of any well-managed firm. And so if we think about it, and this coming back to the corporate governance system, and Elizabeth mentioned the players in a corporate governance system. And so there are many, and they all affect the corporation's goals, actions, and outcomes. But what I want to focus on today, and what I've focused on for many years now, is the institutional investors, the shareholders, and they really affect the corporate governance of a company and the corporation's goals, actions, and outcomes in two different ways. One is through their trading, through the stock market, and the other is through their engagement. So they're the dominant investors in many markets. Today in the U.S., they hold over 70% on average of firms. And as I said, they're a major influence on financial markets through their trading. We can also think about their influence through exit or threat of exit, and through their monitoring, which we can think about as voice, as it's so often talked about. And the other thing I think about institutional investors, and again, Elizabeth talked about the evolution of corporate governance over time. Institutional investors have been central to that through the years. So there are many theory models that focus on the benefits of corrective actions through direct intervention by institutional investors, what's called voice, and this isn't nearly the number of papers on that. And then there are other models that have considered activism through exit or threat of exit. And when we look at the evidence on institutional investor voice, the empirical evidence, there's direct evidence about the actions by asset managers or hedge funds, and there's indirect evidence on just relationships between institutional or large investors and corporate governance mechanisms. So we've had, it's too much research to actually list it all here. I'm just going to point out a few because there are fewer papers on the direct evidence on shareholder activism. And they come from two types of studies. One is analyses of hedge fund activism in aggregate. And again, Marco and Hans have had work in this area. And then the analyses of individual activist managers. And again, Marco and Hans have had work in this area as well. And my co-author, Yan Zhao, who presented earlier, we also have a paper on the direct evidence of investors. So one way to measure institutional shareholder monitoring is by using surveys. Why a survey? Well, many engagement measures take place behind the scenes. They're unobservable. The surveys allow us to assess theories on institutional investors and governance, which is otherwise not possible. Exit due to governance reasons are difficult to differentiate from exit for other liquidity reasons, and there are many uncertainties and unknowns regarding climate risk, and surveys allow us insights into how institutional investors think about the issues. So some of the results I'm going to be presenting are from surveys on institutional investors. These are institutional investors from throughout the world. It's two separate surveys. The first survey was with Joseph McCarrahy and Zach Sautner, where we really wanted to get behind the scenes and see what was going on by asking the investors directly what they were doing about the corporate governance and how much was engagement voice, and then how much did they consider threat of exit to be important. Then the second two surveys are both with Philip Kruger, who's here, again, we're based on large institutional investors around the world, and we focused on climate risk. The first one, we wanted to understand the importance of climate risk to institutional investors, and the second one, we wanted to understand more what institutional investors felt about climate risk disclosure. So going back to the first survey, where we looked at and asked about what engagement channels do you use? And we found that the most important engagement channel that they used was discussions with top management, which isn't very surprising. And then voting against management was the next. And then there was exit, selling shares because of dissatisfaction with performance, and then further down, selling shares because of dissatisfaction with corporate governance. And then there's also discussions with board of directors outside the presence of management. And I think if you looked at that one now, it would be even larger, although it hasn't been that long since we did this survey. And then there are other engagement channels. So the overall observations from this initial survey were there was generally very high level of engagement by our respondents. Only 19% had not taken any corrective actions. 81% had done some type of engagement. We also found that investors use multiple channels to engage, that they rely on both voice and exit, and the investors in our survey view exit as a viable strategy over their previous 5 years. So 49% had exited because of performance and 39% because of corporate governance. And in general, we found widespread use of behind-the-scenes engagement. Okay, so what I'd like to do is focus on climate risk and institutional investor influence. And I think you could use this for other types of E issues, other types of S issues, but here I want to talk about what we found about climate risk. So first, and this won't be surprising to any of you, but just some of the predictions on the cost of climate risk and how important it is. The CDP in June 2019 said the world's biggest companies face $1 trillion in climate change. In October 2020, the CDP and University College London said climate change costs to reach $31 trillion a year if emissions are not urgently reduced. And then in 2021, CDP said that the environmental supply chain risk to cost companies $120 billion by 2026 in present value terms. Now, one caveat is that these estimates are based on future expectations, and there exists a lot of uncertainty regarding what could happen. Okay, so what are the challenges and issues with climate risk for investors? Well, first of all, climate risk is not just an environmental risk. It's also a social and governance risk. And what we still need to understand for any given investors is how much is due to financial concerns and how much is non-pecuniary, but in other words, based on their taste and preferences. So in the survey that Philip and Zach and I did, we asked about investor motivations to incorporate climate risk into their investment process. And we found a set of motivations. We didn't find one overriding motivation. And they could say more than one, and the motivations aren't mutually exclusive. But protects our reputation was by a little bit the highest, then is a moral ethical obligation, is a legal obligation fiduciary duty, is beneficial to investment returns, reduces overall portfolio risk, reflects asset owners' preferences, or reduces tail risk. So notice that out of this set of motivations, some of them are financial, and some of them are based on non-pecuniary preferences. So I've indicated the financial ones here. The non-pecuniary preferences were the top ones, although I guess you could argue the legal obligation fiduciary duty is kind of a combination of both. Okay, so again, what are the challenges and issues with climate risk? It's also difficult to price and hedge, and Patrick's shown this, due to its systematic nature, a lack of sufficient disclosure by portfolio firms, and difficulty in finding suitable hedging instruments. It's become a first-order topic for policymakers, so it's increased the regulatory risk component and requires consideration of its time-varying nature. It's usually considered in light of its negative effects on asset values, but it can also provide return opportunities, and we should take that into account as well. Okay, so one of the things we asked was the importance of climate risk to institutional investors, and we divided transition risk into the regulatory risk component and the technological risk component, and those we found to be very high. The physical risk was also high, but not quite as high, which makes sense because a lot more companies are exposed to the regulatory risk and the the regulatory risk and the technological risk than to the physical risk. We also asked the investors, what they thought would happen to temperatures by the end of the year, because we wanted to get a sense from them on the urgency they saw in climate change. And what we found was that 4 in 10 expect a rise that exceeds the Paris target. So these are divided up by different regions, but you can see for almost all the regions, they thought in terms of being up to 3 degrees or more than 3 degrees was quite high. We also ask about time horizon. What horizon do investors put on climate risk, and when they expected them to materialize? And the dark green on your left is regulatory risk. Next to that is physical risk, and next to that is technological risk. And this survey was in 2018. So already then there were a majority of investors who thought regulatory risk had already started to arise. And given it's been more than 2 years now, at least 75% should believe climate risk are already materializing. So when we talk about the pricing of climate risk, they can impact equity and bond markets. We have evidence on this, and again, Patrick has a number of papers in this area. But then there's also some evidence that markets may be unable to correctly value them, and there's lots more of this. So I thought I would spend just a few minutes talking about how investors react to changes in regulatory climate risk. So this is based on a paper with 2 of my PhD students, Lee Seltzer and Chi-Fei Zhu. And what we wanted to know was whether climate regulatory risk affects corporate bond risk and pricing. And so our hypothesis was that climate risk would be borne by the corporate bond issuers and the investors, and it would occur particularly through the risk of regulatory enforcement. In other words, the changes in regulations about climate risk. So we looked at the Paris Agreement as a natural experiment. So you might say, well, why corporate bonds? Why aren't you looking at equity? And if you think about it, and as Guido has pointed out, for corporations, because they're constantly raising funds in the bond markets, it becomes the bond market rather than the equity market is really the marginal source of finance. The other reason we wanted to look at bonds is because for most firms, climate and environmental risk are fundamentally downside risk. And then further, in the cross-section, downside risk has been shown to be the strongest predictor of future bond returns. So this is just a real quick view of we did a difference in difference analysis between firms that were in the high emissions industries and other firms, looking at their traded bonds and what happened. And so the blue dotted line shows that there was little difference between the high emission industry bonds and the other bonds prior to the Paris Agreement, but after the Paris Agreement, you can see a significant shift down in the credit ratings. And we use 4 different types of definitions. We have high emission industries, we used carbon intensity, we used high emissions, and then we used a low E score for problems. And we found the same results no matter which definition we used. So we also looked at yield spreads around the Paris Agreement, and we found, again, that there was this change in the yield spread after the Paris Agreement. So the first one we were looking at ratings, which means it was the rating analyst. This one we're looking at prices, and which means it's the investors. And in this one I've shown the example of the below median environmental score. Okay, another thing that you might be interested in was we also found results around the presidential election in 2016 when a Republican administration took over, and we found, and then the announcement. So we found that the investors reacted on the yield spread after kind of reversing some of the results after the election, when the announcement was made in June 2017 that the U.S. would withdraw, the ratings agencies reacted at that point. So one other thing I wanted to show is how the institutional investors reacted in terms of their holdings. So it tells us something about exit here. And what we found, if you look at all institutions, they tended to sell out. One of your first questions is probably going to be, well, wait a minute, if the ratings went down, maybe they sold because of a bond going past investment grade. That is not what we found. We took those out, and we find the same results. But we found that this was driven by the insurance firms. The mutual funds were actually buying in. The insurance firms were selling out. And if you think about the insurance firms are the long-term investors, the mutual funds are the shorter-term investors. Okay, so then we ask the institutional investors, what approach do you take to incorporate climate risk management into your investment process? And we found, again, we offered a number of different possibilities. These are not mutually exclusive, and we found that they use a variety of approaches. The top 2 approaches were to analyze the corporate footprint of the portfolio firms and to analyze stranded asset risk. We also found that the ones that analyze the carbon footprint, then many of those would reduce the carbon footprint of their portfolio firms, and the ones that analyzed stranded asset risk actually reduced the stranded asset risk in their portfolio. We also found that they believe general portfolio diversification and ESG integration were approaches to incorporate climate risk. Interestingly, divestment was the least used approach. Okay, so given the divestment being the least used approach, I want to talk a little bit about exit invoice with regard to climate risk. And this is from the divestment database, where they update it pretty regularly. So this is the growth in divestment commitments in terms of institutional investors that have made public commitments to fossil fuel divestment, and the size of the organizations that have made these of the assets under management of the organizations that have made these commitments is about $40.48 trillion. And it's over 1,500 institutions. One thing, if you go and you look at which types of institutional investors have made these commitments, you will find that endowments and foundations are the largest percentage of investors that have done this. That's not the largest investors. Okay, so there's both theoretical and empirical evidence on the effectiveness of exit or divestment, or the threat of exit, and I just want to talk about a few. These were not in particular with climate risk, but they have implications for divestment because of climate risk. So there's one that says exit should be ineffective given most managerial compensation contracts. The managers don't have incentives to divest. I mean, don't have incentives to be affected by divestment. Burke and Van Bingsbergen have said that the effect on the cost of capital will be too low to make a difference on managerial decisions. And then Brocato, Hart, and Zengalis argue that the effectiveness depends on the motivations of a majority of the shareholders. In terms of empirical evidence, there's an older study that looked at South Africa and found little discernible effect on firm values from the South African divestments. And then a recent study found that exit can be effective under certain conditions, including having E&S conscious institutional investors. There's also evidence on coordinated voice. First, there's the evidence of the different collaborative efforts that we have from institutional investors, such as the CDP, the Portfolio Decarbonization Coalition, the Transition Pathway Initiative, the Principles of Responsible Investing. And again, they show that collaborative engagements on climate issues can work through the PRI. There's also indirect and direct evidence that coordinated engagements can work, which has implications for climate risk. And so one of the things we asked in our survey was, what kind of engagement do you have on climate risk? And we found, again, that holding discussions with management regarding the financial implications of climate risk was the number one engagement. And then proposing specific actions to management was the number two. Voting against management was the number three, closely followed by submitting shareholder proposals. And questioning management on conference calls. We found that they use multiple engagement channels. Most of them use 2 or 3, and then the ones that use 0 was only about 16%, which was close to that 19% we found from the earlier survey. Okay, I'm worried about how much time I'm using. Okay. So I wanted to talk about disclosure. And given that financial market efficiency relies on timely and accurate information regarding firms' risk exposures, we need high-quality information on firms' climate risk exposures in order for people to make informed investment decisions and for the correct market pricing of climate-related risk and opportunities. And if you think about it, then sound disclosure on climate risk is also essential for the regulatory efforts to protect financial stability. So one of the things we asked the investors was how important do they consider climate risk disclosure? And the choices were much less, equally important, much more important. And what we found was that 79% believe climate risk disclosure to be at least as important on financial disclosure. And I think this has implications for the SEC proposals on climate disclosure, whether it should go as far as the SEC wants it to go, I don't know, because there are institutional investors that want climate disclosure, but they don't want it to be quite as expansive. And we also found that the investors who thought it was more important were those that had larger assets under management, they had a higher ESG share of their portfolio, and they believed climate risk to be more financially material. So we also, wanted to know, if you think about, well, how does carbon-related disclosure differ from financial disclosure? And it's often demanded by a wider audience, such as consumers, community members, policymakers, as well as investors and regulators. It's multidimensional. It's difficult to measure in monetary terms. It's hard to compare and standardize, and there are externality benefits that go beyond the firm. So some examples of issues, if we think about carbon emissions as a measure of risk, and we've talked about this today, this morning with Patrick's paper and Philip's paper, the question is, scope 1, 2, or 3, whether to use carbon intensity. So there's a lot of uncertainty about what we should use as a measure for risk, and then consequently, what should the firms disclose. In most countries, companies do not have to report their scope 1, 2, or 3 emissions. So we don't even have the basic information for many companies, although it gets estimated by service providers. We ask if they engaged or plan to engage their portfolio companies to report according to the recommendations of the Task Force on Climate-Related Financial Disclosure, and we found that 59% said yes, they plan to engage their portfolio companies to get them to disclose more. And again, we matched this up with other information we asked in the survey. So we didn't know the identity of the people who responded to the survey, but we did ask information so we could do some cross-sectional comparisons, and we found that it was those with a higher ESG share of the portfolio who engaged. They believe climate risk to be more financially material, and they're located in countries that had higher social norms about the environment. We asked the investors' views on their own disclosures, and 60% said they plan to report the carbon footprint of their portfolios. Again, those were those that were larger in terms of assets under management, that had a higher ESG share of their portfolio, and that believed climate risk to be more financially material. Okay, so then we had some hypotheses about how institutional investors are reacting to disclosures. The baseline relation, we found that climate-conscious institutional investor ownership is positively related to climate risk disclosure. So better disclosures were coming from companies that had a higher ownership by these climate-conscious institutional investors. And then we considered the cost and benefits of the climate-related disclosure. So the effect would be weakened if the proprietary cost of the disclosure are higher, because you need to consider the role of competition and how that could affect the firms. The effect was strengthened if the information production costs of the disclosure are relatively lower. So if you consider for larger firms, they would have lower cost, or they could handle the costs better. And then the effect was strengthened if the externality benefits from the disclosure are higher. So, the role of carbon emissions. So we looked at who owns the firms with better disclosure, and we found, and I'm not sure how well you can see this, but just to give you the gist of this, there was a relationship between the scope 1 disclosure and the type of ownership. So we looked at universal owners, which are the institutional investors that own most companies around the world, and so those externalities between the different companies are going to affect them more than other investors. Those investors that came from high norm countries, and then those investors that came from countries that have stewardship codes. With all of those, we found a relationship between the better disclosure and the firms. And we found, consistent with the hypotheses about the disclosure demand, that the effect of climate-conscious ownership on climate-related disclosure was moderated for firms that you would expect to have high proprietary costs. They were in more competitive industries. It was magnified among large firms who should have lower information production costs, and it was magnified among firms in highly carbon polluting industries. So we also considered the difference between influence effects and selection effects, because the institutional investors could have either through their engagement, the influence effect, or through their trading, the selection effect. And again, we looked specifically at climate-conscious institutions, and we looked at the influence effect by looking at the imposition of French Article 173 to understand the influence versus the selection effects. And 173 required, you probably all know about this, but just in case, it required that the institutional investors, not the firms, disclose the carbon emissions of their portfolios. And so you can understand the firms are going to then want their portfolio firms to give them that information. And so what we found is that there was the firms that had high French institutional ownership were more likely to have Scope 1 disclosure, afterwards than before. Again, and so we attribute this to influence effect from the French institutional owners. So in conclusion, institutional investors are an important influence on firms' corporate governance. Evidence shows they use both voice and exit. They have the ability to influence corporate boards and management with regard to climate risk management. According to the institutional investors, climate risk are important investment risks with financial implications for portfolio firms, have started to materialize, especially those related to regulation. The institutional investors are using both exit and voice with regard to these risks. We also find that institutional investors value and demand climate-related disclosures. Their disclosure demand is affected by climate-specific disclosure costs and benefits. And we find that influence effects explain the equilibrium relationships between institutional ownership and disclosure. Thank you.
Thank you for this excellent overview of the role of institutional investors in specifically the area of mitigating climate risks and enhancing disclosure. I suggest that for the organization we'll have very much time. You were more than on Swiss timing, so...
I've been around Carolina.
Okay, so that's the point. So I suggest that we start with the discussion and then we open it up to the Q&A, if that's okay with everybody. So I think it's my pleasure to introduce now Guido Fürer. I think he's an ideal discussant for this paper. I know Guido since... I think almost 20 years now, we can say, oops. And he's the CIO of Swiss Re. So Swiss Re, for those of you who don't know it, is one of the largest reinsurance company, a multinational company based in Zurich, Switzerland. And Swiss Re, through the guidance of Guido, essentially, who's been the CIO for more than 10 years now, has very early on shifted its large asset portfolio, and for insurance and reinsurance company, that means mostly the fixed income part of the portfolio, towards incorporating ESG principles. So in some sense, he and the company have been pioneers in shifting towards responsible investment, and I think the title of his talk is perfect in this context, being a responsible investor in practice. So what does it mean? From your, Guido, from your perspective. Thank you Do you want to stand or sit? Stand.
Okay. Thank you very much for, first of all, the invitation and the very nice introduction, Rajna. It's a big pleasure to be here. Buonasera. And again, a lot of admiration that you're still here, knowing that there's a swimming pool around. So I also decided to stand up to make it a bit more lively. I think what we heard is an excellent outlay by Professor Sparks, what is currently going on in institutional area. It's a lot, and also I could attend a few paper presentation during the day, and it's so enriching. And for me, it's probably a prime example where basically research together with the real economy can make a big difference if we learn from each other and basically also leveraging each other's capability. And I strongly believe institutional investor can do much more than what we currently do. We know we're managing about 90 trillion. If I take all pension fund, all insurance, and if you sovereign wealth fund, 90 trillion. If you direct those money, you can achieve a lot. And we know the whole energy transition probably needs a lot of joint funding. That's why, for me, it's a great opportunity to quickly explain how we approach this. Ryan already mentioned a bit the background. I think it's a bit of self-interest, what we're doing on the asset side. Again, Swiss Re is a global reinsurance company. We're also the biggest natural catastrophe reinsurance company globally, besides the biggest life and health reinsurance company. Now, if you're the biggest natural catastrophe reinsurance company, you want to look what is going on the E, and on the social, and on the governance. Now, just from a risk management point of view, it's clearly that we shouldn't doubling up. With other words, if we take a lot of climate risk, a lot of environmental risk through the insurance offering, you have to make sure that you don't do too much doubling up on the asset side. I think that's a unique setup which we have as a company. That's why we are very close to the topic. Our papers, they go back to 1970, where we warned about climate, global warming, and what effect it could have. And of course, situation has not eased, it's the opposite since then. That's why we try to provide risk transfer, which has a very important element, because it gives a price. It gives a price to a risk. It gives also a signal how much capacity the private market is willing or capable to absorb. And these are very important signals, besides kind of risk transfer in the form of knowledge, which we're also doing, and ultimately also offering solution. Now you see a few commitments which we made, and I say they have been done based on a commercial context, and one of them is on the insurance side. Again, we pledged, as you heard from others, to this 1.5 degree. We heard Generali early on. Swiss Re was one of the co-founders of the Net Zero Insurance Alliance. We have done similar thing on the asset side. Again, we kind of steered the activity. We are co-founder of the Net Zero Asset Owner. Again, this is a very meaningful club in the meantime. We have, I think, around 70 members with close to, I think, 10 trillion under management. And also we want to be net zero as a company. Each of this kind of ambition has a specific timeline to it, and I'll give you a few examples how this looks like. And from a research point of view, similar to what we heard before from Professor Sparks, yes, if we don't do anything, this becomes very, very costly. And we have a Swiss Re Institute with more than 400 colleagues doing just research. And they come to the conclusion, globally it's a 20% GDP impact by 2050. And I think the figures which you showed, they go exactly in the same direction. But it's very different depending on the region. We did it for 48 countries, which represent 90% of the global GDP. And we see certain areas, certain countries are much more exposed. Of course, this helps to assess what is needed at which part of the world. And you see Asia is particularly vulnerable for certain activities. But that's itself, or is a reason enough to think about how I can basically navigate, how I can make sure that this doesn't happen, because how I can avoid 20% GDP drop potentially. And from that aspect, we try to approach it from an economic approach. Again, we are a listed company with certain fiduciary responsibility. Whatever we do also has to be explained and has to be understood by our stakeholders. And stakeholders, yes, are regulators. We have shareholders and of course, financial market more broadly. What you see here is kind of listing, we try to make some format, some structure for ourselves, and the way how we think, at least on the asset side, is we have an enhancement initiative, and one of that is how we can make sure in investing, how we can enhance basically the effect. And some of those measures I come back in a second. Then it's inclusion, that they take up specific topics, be it green investment, be it renewables, etc. And exclusion. We don't get around that piece, and we also heard this morning a few papers, and again before in the reference by Professor Sparks. Yes, insurance companies have solved based on certain law, on certain changes on the regulation. We saw it has been picked up probably by others, and you mentioned in that specific circumstances were mutual fund. That's an interesting piece from an investor point of view. Is it a zero game? In other words, if you have a few who are selling, and who takes it up, and for which price? And for me it's clear, yes, there's always a buyer. The question is, what is the preferred owner? Do you want to have a long-term investor like an insurance company? This has a lot of value for many companies. Or you want to basically have a hedge fund, which has, or the mutual fund, which has a 1 month horizon. That means the more volatile your stock or your corporate bond is, I think the higher risk, basically the risk kind of premium which is asked for. That's why it makes a difference. And I always say, if you have a lot of institutional which are selling, of course, this will lower bid prices. And yeah, someone will pick it up, but this gives a price signal to the issuer and to future borrowing activity. Now, we have also a lot of figures, and here have just a very simple chart how ESG investing has performed. We just took here as illustrative the MSCI, the traditional ones compared to the ESG ones. In most of the cases since 2015, we actually had our performance results in our portfolio. Now, this year not. It's a new phenomenon. We had a 7 or 8 months underperformance. We need to explain. Now we are long-term investor. I mentioned before, we are the biggest life reinsurance company. We have cash flows out to 60 years. That's why we look everything from the long-term perspective. We know in certain quarters it doesn't work. And this year, absolutely, it didn't work from a performance point of view. In many cases, for example, also in March 2020, when we had the COVID outbreak, there we saw two things. First of all, a completely different volatility of our ESG portfolio compared to a normal one. That means you have a lower capital charge. This works particularly well for a company which looks performance on a risk-adjusted basis. So total return funds, I think, have a less of an advantage, but most of the regulation, at least in Europe, for insurance companies is risk-adjusted. That means if I have a less exposed portfolio with a low volatility, I need to put less capital aside, which then potentially supports a better risk-adjusted return. Sharpe ratio, it works in the long term. Different depending what time series you take. Short term, yes, sometimes it doesn't work. And right now we are in such a situation. Thanks God, we look through, we look the long term, and of course we look at it also from an aggregated point of view with the insurance portfolio. Now, what type of action we have taken besides the commitment? We believe set target makes sense, and whatever you have to report will also be done. And that's why to publish certain things or to be asked to publish certain things will provoke action. And what is not measured is probably less relevant. That's why we set targets. We use a lot of energy, a lot of time, a lot of resources in the Net Zero Asset Owner Alliance. Now we can say the effect on the portfolio not yet visible, and also we heard it this morning, not in some of the paper discussion. Our ambition was not only have 2050, but as close as possible. And when we set the target last year, we went for 2025. This is another 2-3 years. It's very close. And we committed as an alliance to reduce the CO2 footprint between, I think, 16 to 28 degrees. This was the commitment by the alliance within the next 2-3 years. Now, Swiss Re, we went with 35%. Based, we had our experience since 2015. We thought that's manageable, it's doable. And you see on the bar chart the effect in the portfolio. This is only since 2018. And you have basically our fixed income, corporate bond portfolio, and then you have the equity portfolio, and the aggregated one are the gray bars. But you see in all asset classes it goes down, and particularly in equity it goes considerably down. That means the footprint could massively reduce within these few years. But that's what this is our portfolio, and I hope you see more of such type of reporting from other net zero asset owner alliance, because there's a clear commitment and we have to deliver. And there's a very rigid discussion. What are you doing with members who do not comply? And there's a huge pressure from companies which comply on the others. That's why you have the healthy peer pressure. That's why it will be probably hard to stay in the alliance if you don't can quantify your progress. This is published. This is also reviewed by different bodies. Also, this is not just window dressing. This is real. This is a CO2 footprint of our portfolio. And I think it's a good example. Then take action, of course, in the portfolio through shifting. Then we measure it, and as mentioned, reporting is a very important one. We work with TCFD since 2016. We help them to frame the reporting, and it again should allow others to follow the suggestion. Then we have specific commitments, like yes, certain renewables allocation. We do so much green bonds, and ultimately we engage with company. This was also researched. What is the effect for us as an individual company? It's hard to measure our own impact. That's why research, as you have done with surveys with other institutional investors, is super helpful to see. Yes, actually, voice makes a difference. Exit is always the last measure, and we know the dilemma. If you exit, yes, someone probably will buy it, maybe for a lower price. That means it's getting more costly for the company to issue paper, and in that sense, market works. If you issue and you have to pay 10 basis points more in the long term, and if you're a big borrower, yes, this has a direct impact on your cost of capital. Now, the way how we engage is voting, of course. We vote between 97 to 99%. This is 2021 figure. This is more than 5,000 votes, which we're doing. In respect of engagement, it's a huge investment which you're doing from a time perspective. And so far we engaged on these two main topics. One is, of course, we need to understand the business model, how the company achieves this 1.5 degree. And again, we believe not everyone will achieve it. Again, it would be great. I think the case study which we heard this morning, the analysis, if you assume everyone assumes it's getting easier for an investor, but probably not. Now we engage, again, just to show this is important. This needs to be explained how a company achieves whatever the targets are, be it by 2050 or short term. 66% so far. Then we want to know how results are published. This reporting is important for us, but I guess for many other institutional investors. We need to understand it has to be user-friendly. And so far with 60 of our companies, which we have in our portfolio, such discussion have happened. We will continue. It's good to see that it has an effect, so that it's not kind of lost time. And the reception, of course, is always a positive, because we had hardly any discussion where we felt, okay, this is probably more a waste of time. It's the opposite. I think companies, they feel under pressure. They want to engage. They want to engage, particularly with long-term investor. Doesn't matter if it's our company, another long-term investor, but this is the preferred shareholder or owner of corporate bonds. And that's why working towards a common goal, it's of everyone's interest. Now, what are the challenges? It's clearly walk the talk. The 250 commitment, that's easy, because most of us will not be here anymore, at least not in a managerial function. That's why we need to have tangible targets which are not too far away. And yeah, we have to walk the talk, and we have to show it, and to avoid greenwashing. So many of you sit in boards, and of course there's hardly any board where the reputational risk or what type of legal action are possible are not discussed. It's getting a bit more challenging, a bit of a minefield. That's why whatever you do has to live up to high scrutiny in every respect. And this is happening, but this shouldn't stop us walking the talk. Then framework, it starts with reporting, it starts with how we measure it. I just believe the broader the efforts is, the better the coordinate, the more meaningful, the easier the outcome. And right now I see a lot of great initiative, but it's hard to find out now how I can bring everything together. And again, Swiss Re committed to different framework, be it Net Zero, Asset Owner Alliance, Insurance Alliance, the SBTI, Science-Based Target Initiative, but some of the goals are not compatible. That means you face a challenge as a member of them. And again, that shows the more coordination, the more steering happens, the more promising probably the result is. Public policy. I feel they can be supportive, they can provide incentive. Right now I see a huge gap, and I'm coming back. If you can engage institutional money, you can move a lot. And we need institutional money in order to manage the transition. Right now I don't see incentive. Now there are good and there are bad incentives, but the minimum is, I think that there's some recognition that this transition is an important one, not only from a stability, financial market stability point of view, but ultimately also cope with the biggest risk which we have as a society, as a humanity. And we have all the figures, and the research paper would probably support many of the figures. These are good. This is a good direction. Actually, it's a risk-reducing direction, and that's why you would assume also frameworks or policy could be much more supportive. And that's clearly another item which I believe needs a lot of additional push. And we can talk about carbon pricing and to have a marketplace where we can actually trade carbon offsetting rights. These are all measures which would be huge, huge progress. There's a lot to do, a lot of challenges, and many actually we heard before, also from your presentation. That's why I see a lot of complementary aspects. Thank you very much.
So maybe if I can open with 2 or 3 preliminary questions based on what we heard from the academic perspective with Laura's very comprehensive talk and Guido's talk. I was wondering if the 2 of you could comment on where you see the gap between academic research and responsible investing as you live it on a daily basis. Where do you think maybe, Laura, academic research needs to go from now on when it comes to climate risk, when it comes to disclosure? Are there some specificities that you heard that trigger some ideas?
Yes, and I guess the biggest one is getting the data on particularly what insurance companies are doing, how they're valuing it. The academic knowledge is so lacking in what the investors, the insurance companies are really doing. And so having the data, I think would be I realize that it's proprietary data, but if you could let some academics come in and study it and understand better what's going on, to me that would make a big difference in terms of our research. So I'll just lobby you for that.
I think, Laura, it's a very important point. We have, of course, not on all 3 lectures. It's clearly for us the S probably is the most difficult one to quantify. On the climate, which is part of E, there, of course, being in that business for many decades, we have a lot of data, and I always say one of the contribution of insurance is we give a price, and the price is based on data. Of course, you have backwarding, but you have model. So in other words, you insure the future storms or the earthquake or flooding, and that's why linking some of those model which we have with maybe how a trajectory could look like, and what would be the right mitigation, would clearly be something which it's in everyone's interest. And we leverage this in-house. Again, that's our kind of proprietary method, which we of course use also for the asset side. That's why we made this move not just to be an early mover. For us, it was very clear on the asset side. This is something which is completely mispriced by the market, and that's why we started the move a bit earlier. You can do certain things as an investor, but you need also the framework. And if you look at kind of the ESG bond, so that if you look at the fixed income where you did a lot of research, there's about 130 trillion, I think, the global fixed income market. Right now, I see only about 3%, about 4 trillion is the stock in the market. Now, you can still argue it's a niche, and if you see the potential, it's huge. And that's why, maybe another point coming back, Rajna, I was surprised about your fixed income interest in your research and in your paper, which it's a perfect fit with insurance company. As you know, we have about 80% of our asset allocation is fixed income, because you try to match future liability, and the interest rate component has a very important aspect. Now, but your argumentation was different. You have taken corporate bonds as basically the marginal piece, which then would allow the issuer to go to the market or not when it's needed. This was, for me, a surprising conclusion. I would have thought an equity piece is basically the primary factor to price the risk, because you're closest at risk of the company. And if climate risk is one of them, you would look at equity. Because from a corporate bond point of view, it's the default, but the default is linked not only to climate risk, but just to plain or little liquidity issue or other aspect. That was an interesting contribution which you made, why you have focused on corporate bonds and not on equity in your research.
For me, maybe another question on disclosure. I think you talked about the survey, about the importance of disclosure, and it reminds me a little bit of the debate we had in the 90s and the 2000s about risk management disclosure in the financial services industry. So in my view, what's important is not whether firms disclose or not, is how they disclose and the quality of disclosure. And what I see is a proliferation of standards in terms of ESG, in terms of climate. And so how in this context, how important is it to assess the quality of disclosure and to enforce a better quality of disclosure? So I don't know if your paper addressed that, I haven't read it, but it seems to me that for the investors, that's what matters. It's not whether people report or not, it's whether it's credible and it's sort of comparable and harmonized. So is that something you're working on, or?
Yeah, and we were, kind of focused on the quality, not just disclosure at all, but also the quality of disclosure. And just to give an anecdote, I don't know if many of you have heard about this, but some years ago, Chipotle, which is a fast food Mexican restaurant in the U.S., had in their annual report, how they list all these different risks. Well, they listed, we might not be able to serve guacamole, we might not have cheese and other things, but the press picked up on the guacamole because of climate change. And so it's not a very helpful disclosure, getting back to yours. And the press went nuts with it. They blew it all out of proportion, but it's, having more quantitative, better quality disclosures, I think, is important.
Do you have any?
We spend a lot of time on the disclosure. Again, we try to follow the most relevant standard, but if I just took this is, in the meantime, it's a very thick document just on the corporate responsibility report to show all aspects, and hopefully this is done in a way that it's digestible for it. It's good if you're doing it, but in order to have a meaningful impact, this needs to somehow produce much more user-friendly, and ultimately maybe bring it down to a figure or a rate, like we know it from a corporate bond. What is it? Is it a AA, whatever, AAA? That's why you'd even kind of translated in kind of a tempered score. You can't expect that the average portfolio manager or equity investor goes through all the reports. And that's why, in order to make it meaningful, impactful, the more standardization, the more whatever translation back to something which is easy to capture and to put into your decision, I think the more meaningful. Right now, it needs an army of people who looks at those reports. They come up with their assessment. Yes, then potentially is a recommendation, or it ends somewhere in an index, but it's far away from being user-friendly. It doesn't mean we shouldn't publish, clearly not, but we should work on simplification and standardization.
Maybe I still have a lot of questions, but I think it's unfair to monopolize here, so I don't know if there's, yes, I see that there's hands raised, so we'll go in turns.
Yeah, Laura, I was interested in the survey. I mean, I have to say, if I look at the results in aggregate, it kind of suggests to me that investors don't really care about climate risk very much, because you've got over half of them saying that global warming's kind of merrily heading on to 2 degrees plus, and yet you've got fewer than a quarter saying they're building it into risk management. And I mean, you know, if we actually dig underneath the survey results, it kind of suggests an element of complacency. And I mean, Guido, you interact with a lot of institutional investors, and do you feel they're being complacent? It didn't sort of particularly comfort me, I've got to say, the survey results.
Well, I mean, except that I highlighted the ones that thought it would be more than 3 degrees. You still have the ones that think it's going to be the 2 degrees and the 1 degree. So I think my interpretation isn't the same as yours. To me, that they were concerned. They were expecting these temperature rises.
Yeah, so they were expecting, but notwithstanding the fact that all of these investors expect large temperature rises, a really tiny minority viewing it as a risk management issue. I mean, you have 22% or something saying that they address the climate for risk management issues.
I see what you're saying. For the motivations.
Yeah,
for
so
addressing
actually, you would have thought if people were A, worried about climate change, B, thought we were heading for 2 degrees plus, and thought that would have severe impact, you should see much higher results of people saying this is a risk management issue, not a reputation issue, it's a risk management issue. So it seems to me that this painted a picture of a very complacent investment.
Maybe Philip would like to.
I would have answered to that like Joseph showed a slide where 41% of the sample of investors said that they had discussions with management on investors. So maybe like, as they could choose any of these approaches.
Excuse me? Probably 80% have discussions on compensation.
Well, I mean, that's fine. I mean, I don't know like what the I mean, I think that's not a problem. But I'm just like referring to, I mean, if I understand your point, is that, let's say, I think it was 6 out of 10 that, no, 4 out of 10 that expect very high temperature rises, and then you were saying that, okay, at the same time, 25% of the respondents say they use risk management. Maybe they don't see it as a risk management problem, or as a governance problem, and then, what I'm trying to say is that, 41% of the investors that engage, say that they need discussions with management on these issues. So, I mean, it's kind of like, if I understand your point correctly, what you're saying is there's a mismatch, no? Like,
Yeah, it's a mismatch. It all seems to be
yeah, exactly. Maybe then, maybe like some see more as a governance issue, right, than as a risk management issue. And therefore, like, go through engagement and discussions with management.
Yeah, it could be. It could also. It could be a language difference on what risk management. Because I doubt if you remember this, but it was only 16% that didn't have some kind of engagement on climate risk. So to me, that says they think this is important, that they're engaging on it.
There was another question by Patrick.
Yeah, I have a comment and a question. The comment is about the point you made, Rajna, about disclosure. A lot of the frustration, I think, by investors is with the EU taxonomy. And the best comment I've heard about it, this is what I wanted to make as a comment, is that EU taxonomy is not meant to be about disclosing risks for investors. But what it's meant to do is to channel funding into green investments. And I think that's an important way of framing the EU taxonomy, and it speaks to the paper we heard this morning, and it does seem to work. It does seem to have an effect in channeling funding. So I thought that was an interesting comment. But the question I have is for Guido. So the UK has just conducted, the Bank of England has just conducted its biannual climate forward-looking scenario analysis, which includes banks and insurance companies. And so I was wondering whether Swiss Re itself does something like what the Bank of England would like to do, forward-looking analysis in terms of the risks that are embedded on the asset side, and also on the, because you also expose hugely to physical risk, and that was another point about the Bank of England exercise. Insurance companies, huge, relatively short run, huge physical risk exposure.
Our company is probably a bit special because yes, all our modeling is always forward-looking, but for us it's always a measurement tool for capital allocation. And of course, you do the capital allocation with a forward-looking approach on both sides of the balance sheet. And our main, if you talk about balanced steering, means there's a lot of dependency. We strongly believe some insurance events have also an impact on the financial market and the other way around. That's why to have a modeling which goes across the company, across both insurance portfolio and financial market is super important. And you do it with a forward-looking piece. So if I insure today a certain risk, maybe the claim happens in 10 years' time or in 20 years' time. That's why probably the DNA of our company is always try to find out what is next or how a risk basically does evolve on both sides of the balance sheet. And then we do stress testing. And as a kind of a company which usually kind of engages at the tail event of an event, from a risk, you have to make sure that you survive. That's why we survived close to 160 years, and we want to survive another 160 years. That means you constantly think about the extreme, and particularly also if you look at just from an insurance context. So that if you look just flooding isolated from windstorm, you miss a lot of things because a windstorm can provoke a flooding and can mean the collapse of a financial market infrastructure, etc., etc. That's why you constantly think through all the risk parameters. But ultimately, we try to translate it into a capital or in a cost of capital aspect, and that's why also coming back, what research could do more. The more we can show what is the price to not report on certain risk, or what is the price of neglecting certain risk, if this can be translated into the cost of issuing capital or just cost of capital, that's still the most meaningful measure to attract the attention of both of companies if they need to issue paper, or of course on the investor side. And that's the language which is best understood. And if you can bring this into a market mechanism, then this the most natural way to steer the capital towards towards the right companies, but also towards the right risk, or ask for more compensation if someone doesn't care, basically. And that's why if you want to be effective with research, that's probably core for the whole discussion, to attract and steer the capital into the right direction. But it needs reporting, which is understood and done.
I think Caroline had a question.
Thanks so much. It's actually more of a comment than a question. Apologies for that in advance. But actually 2 comments. Guido, just as a very quick reaction, and I would just like to highlight and emphasize Laura's point from before. I think data access is fundamentally important. And, for all the corporations, investors in this room, if we can find a way how to give access to some researchers with an NDA or so to data, it would be phenomenally valuable for research and practice. Now, to my comment, I think we are all concerned about the disclosure of climate risk exposure of the companies. Investors are very much interested in this space. Now, another question is, one question is, how do we get the portfolio companies to report their exposure to climate risks? But the related question is, what do they actually do, correct? Whether and how companies adapt to their exposure to climate risks. And so one of my PhD students who is actually on the market, she looks at adaptation strategies of companies to their exposure to climate risks, and it is disturbing what she finds. Less than 30% adapt to climate risks, and primarily through risk management. So what does that mean? They don't engage, they don't invest in long-term strategies, adaptation strategies. Most of the companies are still perceiving it as, let's do a quick fix in a short term. But her findings basically imply the world is utterly unprepared for climate adaptation, for climate change. Sorry for this very negative note. I know we have afterwards drinks, so I feel better about that one, but I hope somebody else can end this conversation on a more positive note.
Is there some other questions, comments, Marco?
Yeah, so Laura, you talked about public markets, of course. What do we know about private markets? Is there something we know about private equity? I think we heard before that, of course, one thing that companies can do, especially if Patrick is successful with his proposal, you decarbonize listed markets, but then what you can do is M&A and just push the brown stuff into private equity. And then turning to you, Guido, since you buy bonds, do you buy bonds from private equity buyouts? And do you think that, if you do you have an idea whether, your shift in the way that you buy bonds has an impact on private equity?
It's clearly, a private market doesn't have the same transparency per definition like public. That's why when we engage with private market, if it's a transaction, for example, infrastructure, we do transaction ourselves. We directly work with the operating company. There you can assess if it fits in your climate or whatever ESG strategy, and even score it, and then either you find it attractive or not. But if you buy into funds in the private market, you can only go as far as you instruct the manager. What are the criteria? What is the threshold? What needs to be reported? But it's very clear you don't have the same granularity of data. The exclusion list helps, so that you say certain sectors or certain companies with a certain footprint are no-go, but this is more on the exclusion basis. Now, what you also hear in some of the statements, that by 2030, 50% of the financial market will be done in private market. Just to add a bit to the importance of your question, Marco, there's clearly a tendency that the private market is not getting less important. And And if this is the case, how we can make sure that the private market lives up to the same, I guess, expectation which we have of the public market with respect of issuer, but also investor behavior. I think absolutely under-researched area. We all work with the liquid market because we have data, and regulation also, at least in the insurance context, helps. If you go into listed products, the capital charge is lower compared to the same credit risk in private market. There you have a bit of an incentive to stay, I guess, in the listed market if the compensation is not given. But just from a transparency reporting point of view, this is not getting easier if we stay with the current setup. This gives you a bit of an idea of the dilemma which we potentially face.
So there is some good news, though, which is that the pension funds, the endowments, and the foundations who view private markets as being part of their portfolio allocation are putting a lot of pressure on those private equity funds about, you know, what the carbon footprint looks like and what kind of business they're engaged in. And so I think there is, even though they're private firms, because so much of the private equity market is held by these institutional investors, the institutional investors are putting a lot of pressure. So I don't think it's that every private firm is able to escape from this.
I think there's a question from Hedengran.
Just one question to Mr. Fürer. When you look at investments, do you also actively look for companies that are, you know, sort of on the brown side but have a transformation journey to do, where they have, you know, good plans and patent applications and so forth, where you can really, you know, be part of funding something going to green, where you make a real impact?
Thank you much for the question. I haven't clearly mentioned before. The exit or the kind of the voting with the feet, this is for us always the last measure, and we try exactly what you ask for. We try to fund the transition. Then we work with ESG market weighted benchmarking. In theory, we have the same weight for mining in our ESG universe compared to the non-ESG universe. Basically, not to kill a sector, but to help the company which are willing to do the transition and help to fund the transition. And that's why, yes, we are in brown sectors invested. Within those sectors, we try to favor those which we believe will manage through. There's certain threshold in order that we achieve our own targets, which we cannot invest in certain sectors, but we don't exclude any sector. And in particular, also, we are interested in companies which maybe have still a heavy CO2 footprint, but maybe a very credible story and also report how to manage it. And these are actually attractive companies, both from a potential to outperform, but also helping us to achieve the target.
To end on a positive note, there are loads of business opportunities with all these threats.
Absolutely, absolutely.
Yes.
Okay, so I have a question for you, which is, what do you think about the green bond market, and particularly the green sovereign bond market? Do you think it's going to grow? That there's going to be more demand?
My hope is, yeah, because again, I believe it's far too. I still use the word. This is a niche market, and issuing green bond, of course, it's more demanding. You have to help the investor to show what is happening with the money, and not only at the beginning of the issue, but during the investment phase. It's a more demanding piece. But so far, you see those bonds are usually oversubscribed by a factor which is higher than normal bonds. So it's attractive to issue green bonds, but it's a more demanding piece for the issuer. I hope that market grows. Also government, of course, so that they should go into renewable energy investment and say, okay, the proceed of the fund goes into that specific project. Perfect. Absolutely, we are a big promoter. The International Capital Market Association, they have also developed this green bond standards, and we are one of the user of those standards and also help them to create the framework. I use those associations because they have a certain recognition in the market, and it just helps to basically enable and also organize kind of an investor mass which is needed. And I always say the more green bonds, the better as an investor. Absolutely. Yeah. I hope the market will grow.
Can I ask a follow-up question about these new sustainability-linked bonds, which sort of incentivize the issuer to reach certain targets? Is that something you also sort of envisage in your portfolio? Or?
We absolutely look at them. You increase a bit the complexity. It's a forward-looking, and it's all good and doable if you have a kind of designated team who are capable to absorb the information, to price it correctly, to monitor it. Or whatever we invest and whatever we report, we have to monitor as well. And I say we have a bit of a luxury as a company, because yes, it's our core kind of interest and also the way how we want to use the capital, but always think about kind of smaller companies maybe which are not that equipped. It's a more demanding things. That's why I'm coming back. The more simple you can do it, the more transparent and easy to digest, the more powerful, the more enabler it is for the capital market.
There one more question, yes. Maybe we'll close after that.
Yeah, it was just a question, Guido, about the matching of the two sides of the balance sheet. So you talked about the need to take risk out on the asset side because you're taking climate risk on the liability side. What you've got on the liability side is physical risk. When you're looking at kind of the carbon emissions targets, I mean, that's transition risk. And it's not, I mean, the relationship between the two is sort of, it's not necessarily one-to-one. Are you also taking physical risk out on the asset side? And how do you think about that relationship between transition risk on the asset side and physical risk on the liability side?
Yeah, absolutely, that's correct. That on the insurance side, these are event risk. I would say it's event risk. It's quite often a physical risk, as you mentioned, on the property side. But if you think about it's also health. Health risk is clearly related to the temperature, and we have seen it again in summertime. The health of people is massively impacted by the environment, including temperature. Global warming doesn't just affect physical risk; it also clearly affects other parts of at least our portfolio. That's why it's both physical event, but there's clearly also trend risk, which needs to be factored in the life and health side. Now on the asset side, and we can argue it impacts the quality of the issue or the riskness of the issuer. That's why you need to understand what the correlation is between kind of two events. We try to understand it, but of course it's also learning by doing. Our model, they are constantly evolving and developing, both on the asset and liability, in particular also on the ALM side. But it's clear there's some connectivity, and whatever data we learn on whatever trend we see, be it on the health portfolio, is also relevant for some of our thematic investing. Or for example, we have three big teams which we look at the asset side at the moment. Energy transition is an obvious one, then digital infrastructure, but also the healthcare piece. And that's why, again, we create a clear connectivity between being the biggest health reinsurance globally and now have a designated team on the asset side, which looked at the healthcare investment piece. Knowing that the effect is in some cases it's immediate, like a nat cat, and maybe on an asset portfolio where you engage in a 10-year bond, it impacts the riskness over the life of the bond. That's why the dynamic, but also the capital usage is different. And for us, on the asset side, and I think that's probably a bit the difference, also the liability side, it's the mark-to-market aspect. Or usually in the insurance side, either there's a trigger of the claim, it's kind of a one-off, and on the asset side, you have a lot of kind of mark-to-market aspect, which are not only financial market trigger, but also change of environmental aspect, etc.
Is there any other question or comment? So if it's not the case, I would like first of all to warmly thank Laura for delivering the Wallenberg Lecture tonight. I would like to thank Guido for this very interesting perspective on the practical side of being a responsible investor. I'd like to thank all the participants, but also mostly the speakers and the discussants. I think it's been a very interesting day. I think for Caroline and me, it shows that the agenda is still wide. I mean, we talked a lot about, how do investors operate to become responsible investors, whether they're successful at decarbonizing their portfolios. It seems the answer is yes, but does it make a move or does it change the needle at the level of the real economy? The answer is not so clear. And I think there's other questions that we haven't tackled today. I'm just going to raise maybe three of them. One is greenwashing and the costs and externalities that are associated with greenwashing. The second question that's very dear to my heart is the S pillar, which is sort of the neglected pillar. So of course we have data on the E piece, so we all do research on, it's important as well, but when you look at the macroeconomic environment, you see that social inequalities are rising and that this is also potentially systemic risks. And perhaps the last point I wanted to emphasize in our philosophy with Caroline when we think about this, what should be a research program that not only fosters conferences but also inspires research. I think interdisciplinarity is very important. So finance people should talk to lawyers, should talk to economists, to scientists, to environmental scientists, and we hope that we can achieve some of these targets. So I hope we'll see more of you at the future conferences and events that we will organize. I now leave the floor to Marco for some final words.
So first of all, please note, thank you. Okay, so welcome to the Rector of Bocconi, who is going to I have really two jobs. Well, first of all, to give you I have the low for me at the conference. So the low for me today came from Petra Hedengran. Not because of, that's not because of his paper, but because of the number he put out about the global carbon budget. Because his numbers were old, and we know that what's coming this winter and us switching actually on more fossil fuels and all the rest of it is not going to look, the number next year is not going to look good. And I have to say, actually, Patrick, you don't win the prize. I think the prize goes to Guido because he showed the projection from the Swiss Re Research Institute about what's going to happen to GDP and translate that into inequality, crime, poverty, migration, and all the other things that go with it. So this is really a very bad scenario. So that was the low. Okay, now let's not finish on that. The high for me came actually at dinner last night with the chair of Enel, and Patrick was there, so I'm not making this up, who explained to us that actually Enel thinks that renewables, they can do, actually replace fossil fuels with only renewables, and they can do it within 8 years. Now, if you think I'm making this up, Patrick was there? Okay. So now you can say he wasn't telling us the truth over dinner, but he had 3 or 4 glasses of wine, and I don't think he was lying. So that for me was the high of this. And with this, my duty is to thank you and to give a little plug, of course, thank Rainer and Caroline for organizing the day today, and to give a little plug to Laura and Caroline, because they are organizing next week the PRI Academic Network Conference, which is going to be online, and you can all join, free of charge. Okay, so that was the plug for the next big thing. And now it's my privilege and honor to thank Bocconi and the rector of Bocconi, and to congratulate you, especially on your new campus. And everybody has been talking about your new swimming pool. And, but of course, that was actually also serious. Now, of course, we are extremely grateful to Bocconi, and we talked about the history of ECGI today. We've actually been to Bocconi before. I don't know if you know this, but the founding chair of ECGI was Antonio Borges. He was very good friends with Mario Monti, and we came here, and Antonio was actually an advisor to Mario Monti about transforming Bocconi. We came here many years ago. I mean, it's remarkable what you've done with Bocconi, and I think many, I don't speak for all the academics in the room, but certainly, when I look at my home institution, I'm somewhat jealous about what you have done and achieved. And I've heard noises that even, some well-known universities in Switzerland are quite impressed with what you've achieved. So it is really quite remarkable, and thank you for hosting us today.
Thanks so much for these very generous words. I would like simply to wholeheartedly thank you for attending this conference. I'm just arriving from outside city, so I'm sorry if I came at the end and not at the very beginning, but I wanted to be here because I would like to wholeheartedly thank also ECGI, which I believe is an institution that is doing the right thing in these days. We like to say at Bocconi that we are rewriting books of capitalism. And this has to be done, by the way, not simply by economists, not simply by lawyers, not simply by material scientists. It's an endeavor for all of us. And the cross-contamination across discipline is crucial, is really crucial. So what I love of this conference is the fact that we put together, scientists, practitioners from different fields, and we try to really understand how we can do better. And we have to do better a lot in what we like to say the E of environment, the S of social, and the G of governance. So it's great because at Bocconi we try to strive a lot in this direction with all our 9 departments, and specifically I thank Professor Strampelli that wanted us to host internally this conference. And of course, these topics are crucial in legal studies, are crucial in finance, are crucial in management, and this is something very. And now we have also big data, right, that helped us in understanding better how to try to find solution to the complicated problems we have to face. So again, thank you very much. We're trying to do better also, as you said, in terms of campus, which is very much okay in terms of ESG, by the way, and particularly also the swimming pool.
No, but let me repeat something to you that Antonio said to me, that he said to Mario Monti, and he said, look, universities are not so difficult to understand. You can have swimming pools and buildings and all of that, but what it's really about research and ideas, and it's about attracting the best minds. And that's what he said to Mario Monti, and I think if the success of Bocconi is what it is today, it's because you have been able to attract talented colleagues also for the law faculty and the other faculties of Bocconi, and that's really the key to your success, and my students and others want to come here. Thank you very much. Thank you.